If you live in Sweden, moving to Dubai could literally save you tens to hundreds of thousands of dollars every year. But only if you handle your tax exit properly. In this video, I'll compare Sweden and Dubai's tax system and show you the key steps that you need to take to move to Dubai and eliminate their taxes. Sweden has one of the highest tax rates in Europe, with income taxes over 50% and strict residency rules. Dubai offers 0% income tax and a clear path to legal residency. I'll explain the key differences and what to do if you want to cut Swedish tax ties for good. Before we start, my name is Shiraz Fahid and I've helped many families and business owners move to Dubai, set up their company and legally reduce their taxes, many of whom come from Europe. And if you want my help in doing the same for you, you can book a one-on-one call with me at setupbureau.com/call. Now let's start by comparing the income tax. In Sweden, the personal income tax can go over 50%. Especially for high-income earner. This includes both national and municipal tax. For many professionals and business owners, this means giving up more than half of what they earn. In Dubai, there is no personal income tax at all. You keep 100% of what you earn. This is one of the biggest reasons that Sweden nationals choose to relocate. The difference in the take-home income can be massive, especially over several years. Next is the corporate tax. Sweden corporate tax rate is around 20.6%. This applies to business profits after expenses, and on top of that, you often have to deal with dividend tax and employee social surcharge. In Dubai, the corporate tax rate is only 9%, and that only applies if your business earns more than 375,000 dirhams per year. That's close to 100,000 euros. If your company earns less than that, you pay nothing. Even at 9% corporate tax rate, it's less than half of what you will pay in Sweden. And also there is no dividend tax. That means you can take money out of your company without the extra tax at a personal level. Now let's talk about the VAT system in Sweden. Sweden applies 25% VAT on most goods and services. This is one of the highest VAT tax rate in the world. It increases the cost of living and makes services more expensive for customers. In Dubai, the VAT is only 5%. This lower rate reduces business costs and make your services or products more competitive in the international markets. It also means day-to-day expenses like dining, transport, and shopping are more affordable. Capital gains are also taxed in Sweden. If you sell shares, properties, or business, you may owe up to 30% of tax on profit. This can affect both individuals and companies, depending on the structure. In Dubai, there is no capital gains tax. You can sell investments, assets, or even a business without paying anything to the government. This gives investors and founders more flexibility and reward for their efforts. And then there is social security and compliances. In Sweden, the social charge for employers are high. They add significantly to the payroll cost, and compliance can be complex. You are expected to maintain a detailed records, file annual reports, and prepare for regular audits. In Dubai, things are simpler. There is no personal income tax filing, and business compliance is straightforward. Most companies file the basic report once a year, and there's no payroll tax or social security costs unless you hire a UAE national. Now, let's look at the residency rules. In Sweden, you are considered a tax resident if you live there and have a home available, or spend more than 183 days per year in Sweden. Even if you leave, you can still be considered a tax resident if you keep strong personal and financial ties to Sweden. Breaking your tax residency in Sweden means reducing your ties. This would include no home or regular presence in Sweden and no ongoing connections to Swedish work, clients, or family life. In Dubai, you become a resident by setting up a company and applying for a visa. Once your visa is approved, you get an Emirates ID, which lets you live, work, and access services legally in Dubai. As long as you're living in Dubai and managing your life and business from there, you're treated as a tax resident of Dubai. You don't need to apply separately for a tax residency status. It's built into your visa structure, and many people obtain tax residency certificate after 90 days or 183 days. To leave the Swedish tax system properly, you must inform the tax office and file your final tax returns. But it's not just the paperwork. You need to prove that you have actually relocated to Dubai. This includes that you're spending most of your time in Dubai, managing your business from here, and cutting ties to Sweden. You should close Swedish bank accounts, cancel health insurance, and avoid spending long periods back in Sweden. Your life must be clearly based in Dubai. Many of our Swedish clients use Freezone setup for their businesses. It's the fastest way to get a visa and doesn't require a local partner. You get full ownership and access to local banking, real estate, and visa services. The Freezone model is designed for people working remotely or online. It also suits consultants, e-commerce sellers, and investors. But once you complete the Dubai process, the benefits are clear. You lower your tax burden, simplify your compliance, and gain access to a stable, modern environment with strong legal protection. Dubai offers high quality of life, global connections, and a safe place to live and work. The legal system is reliable, infrastructure is excellent, and you are positioned at the center of the global business travel routes. So if you want my help in setting up your Dubai company, residency, banking, and exiting the Swedish tax system, you can book a one-on-one call with me at setuphero.com/call. We'll go through your situation and build a clear action plan that works in your case. And if you are serious about moving to Dubai, you should really check out my next video right here.